Hello, ETHDenver. Thanks for having me. What I want to do in the next 50 minutes is challenge a narrative that I think is still to come in crypto. That fees in via vanity metrics, they spike in bull and disappear in a bear, and that the only thing that really matters is token price. However, data tells quite a different story, and I think it has a lot of real implications for how we think about protocol value, how we underwrite investments, and where next generation of winners is going to come from. We have been deep in the data for a couple of months at 1KX, looking into on-chain revenue. On-chain revenue, of course, excluding the bank fees of the big stable guys. And a couple of things that we found were genuinely surprising. And some of them, I'm going to say, might be a bit controversial for you guys, especially for the ETH crowd. And in the end of the day, revenue is a feature, not a bug. So let's dive in. Let's start with the big picture. And I want to spend a moment here because I think this chart actually generally shows one of the most important things you can look at to understand how we're currently at in crypto. Like when you think about back in 21, and I think there are a couple of 21 boomers around right now, 9.3 billion in a single quarter felt like a whole lot of different world. Prices were going vertical, and narrative was that crypto had finally arrived. And then it didn't. Price crashed, project disappeared, we ceased to quiet, and mainstream wrote obituary again. And now, if you think about it, and if you look at the chart, these 9.3 billion in one single quarter is mainly from one source, and that's ETH. Peak NFT mania, people spending a couple of K to mint a funny NFT. Then, of course, the collapse. And now again, second peak, which is much more, I would say, mature or diversified. This peak of the current bull is among 1.2K protocols. When we're speaking about the 21 peaks, we're speaking about just shy of a couple of hundred protocols. And you might think the amount of protocols that are generating revenue may be a cumulative chart, but it isn't. Now I want to look at the concentration story because I think it's actually a bit underappreciated as a data point. I think, because if you think about it, in 2020 the top 10 protocols captured around 95% of all revenue. Again, 95%. And then the entire fee economy of crypto is essentially just these 10 protocols, Uniswap, Compound, ETH, and so on. And the rest was kind of noise. And now, if you skip ahead to 25, that number has fallen to 45.3 percentage points, so roughly halved. There's a dramatic stat, and structured democratization of fees is happening in real time. It has enormous implications for how we think about the opportunity set in the market. Now, 45% is still high. I'm not going to pretend the market is perfectly competitive, but the direction of travel matters is enormous. We went from near total monopoly to a genuinely contested market in the span of 5 years. While the absolute size of the fee economy grew significantly at the same time, the incumbents didn't get smaller. The market got bigger around them fast enough that their fee share fell. So TLDR, an Avi, or a Uniswap didn't become any smaller in terms of fee generation. So the competitive dynamic here looks more like a mature fintech if you think about it. There is no real winner takes it all platform dynamic like in Web 2. Like if you think about it, Google didn't take over the whole search market. So where does all that maturation actually leave us in absolute terms? If you look at the numbers, total on-chain fees hit 19.6 billion in 25. That's kind of a striking figure on its own. Nearly 20 billion paid by real users for real on-chain fees, on-chain services in a single year. For context, that's more than 10 times what the entire on-chain economy generated in 2020. So basically, in the span of 5 years, the whole on-chain economy in terms of revenue, in terms of fee generation, more than 5x. However, if you still compare it to the year of 21, we are lacking behind. And the 2025 bull has been much less prosperous in terms of fee or revenue generation than the bull of 21. And there's one main cause of this. And the main cause of this is ETH. So to understand why this mix is so dramatical, you need to understand what happened to blockchain fees. And I think it's a very hotly debated thing in the community right now. Basically, they collapsed from 7.3 billion in 21 to 1.3 billion in H2 25. It's a 6 billion annual revenue decline at the infrastructure layer. And it wasn't like really a demand problem, because in the same time, transaction count volume on ETH alone 2.7x. It's more of a deliberate efficiency story. L2s, updates, better sequences, alternative L1s with better base fees, better economics, and the infrastructure dramatically and intentionally cheaper. Ethereum now represents just 15% of the blockchain fees, down from 86% in H2 21, and down massively in absolute terms. The remaining fees are spread across Tron, Solana, MEV capture, couple L2s, and pretty long tail of other chains. And now, here's a kind of hot take. And now this will get quite some reaction here, because ETH as a fee capture asset is probably structurally impaired. The roadmap that was supposed to make ETH more valuable, scaling real rollups, scaling TPS, etc., is the exact mechanism that destroyed Ethereum's fee revenue, its economical revenue capture rate. Transaction fees paid to the base layer dropped nearly 95%. And updates made it dramatically cheaper for L2s to post data. Each scaling upgrade is kind of deliberate transfer of value from the base layer to the application layer, which I know is in the plans of being a bit in the debate right now. But still, it's not really a criticism of the ETH tech. The tech, or more like the issue is that the tech is working exactly as it's designed to work there. It's a serious question about what the ETH token model actually looks like in a real world, where the chain succeeds at its own roadmap. So, with blockchains losing share, there are of course other application layers that are gaining quite some traction. And DeFi is a clear winner here. Fees grew from 4.8 billion in H2 21 to 6.9 billion in H25. And remember, average transaction costs fell 86% over the same period. So DeFi is generating more aggregate fee revenue at a fraction of the per transaction cost. Basically, volume doing its work. And if you think about it, each subsector that's was around in DeFi in 21 is still around in 25 and became bigger in absolute terms, plus we managed to add up a couple of other ones. And if you're zooming out in the monthly data, something kind of interesting happens. We're seeing like two very big spikes in the year 25, where you're having January 25 peak Solana hype, and the later one this year, where it's a bit more generalized and not just on Sol. And if you look at that, the just kind of collapsed fee revenue of DeFi protocols hit around 800 million USD in December, which is kind of interesting because that's just shy about the top peaks of the 21 fee generation mechanism. So if you think about it, even though DeFi fees kind of collapsed due to the market changes, we're still well ahead of 21, and actually the 21 peaks are more like the 25 bottom. Now I want to look a bit more on the supply side of this market, because I think there's some unappreciated growth in the entire crypto system. And it's kind of interesting. Tracking here protocols, new protocols that are generating fees or revenue in the same year they're launched. And 25 actually was a peak year in these terms, with 603 new protocol protocols that are generating revenue. And basically, it's fair to say, like a vast majority of these protocols, they won't survive. However, you can think about it a bit like as a Cambrian explosion, meaning that tons of new protocols are entering the market, and they are entering the market in a way where they're able to generate real revenue, real fees fairly quickly. And also a good standout here is as a sector would be Deepin, which actually is the biggest sector of new protocols that are generating fee in the last year. Now, natural question will follow some like, okay, a couple hundred new protocols entering the market. What does it do to the incumbent market share? And that's kind of interesting because 24, 25 combined has a good 44% market share right now around revenue and fee generation. And what's interesting still though is that the category or like that the protocols that basically incumbents like the OGs, Uni, Avi, etc., are still the biggest vintage of protocols generating fees, which is kind of interesting. And now looking a bit on Deepin itself, because I think it deserves its own moment on this presentation, kind of, as it's one of the most interesting sectors right now in crypto in terms of fee generation. And you might think here, when you look at this chart, okay, looks like a meme. But actually, it's kind of interesting as in Q4 25, Deepin protocols made $74 million in revenue, kind of double of what they made in the last year, which was 40 million. On its own number, looks kind of small relatively to DeFi figures or other subsectors in the crypto space we've been discussing, but I want to make the case because that's a pretty good frame here, actually. So yeah, kind of everything we discussed so far: maturation fee base, DeFi structural growth, a new wave of protocols emerging, Deepin having a good time. I want to lay your eyes on something else, the like so-called TVD meta, so total value distributed. Basically, TLDR, there's a real opportunity now for token holders to actually make money by having a token or not just having it by vanity. And actually, we're having a record right now with 3.8 billion in fees distributed to token holders in H2 25, kind of double of H2 21 with around 2 billion. And what it means for how you think about token valuation is kind of significant. For most of the crypto's history, tokens or token prices were driven almost entirely by narrative, momentum, speculation about future potential. But if you think about it, cash flow-based valuation frameworks that work in kind of TradFi had no purpose in crypto because there were no cash flows to discount for. This has just changed. And let me close with a protocol level view. As I mentioned before, the share of, or like the fee share of protocols in the top 10 are right now at record lows. Same goes for the top 20. However, they're still generating 60% of all on-chain fees, Q3. Mageia leads at 1.25 billion, Jupiter 1 billion, Hyperliquid also roughly 1 billion, etc. pp. I guess you can look at the chart. As for the sake of time, I just want to point out one thing, and that's kind of interesting. As we were talking also about transaction cost optimization around Ethereum, is if you take a close look at the top 20 protocols that are actually making money, you won't find too many that are ETH-based, which is kind of food for thought. But in the end, application wars are just beginning. And if you think about it, Hyperliquid is actually a clear signal of where it's heading. So let me close with that. Everything I've covered you can find under this QR code. We published a very extensive you have in the report. You also find all sources and a whole base code basically for all of these 1.3 billion tokens. So yeah, thank you so much.